What's going on, everybody? I'm Gilberto from Credit Guys, the show where we talk all things business, credit, real world, and finance related. Today's video topic, I want to teach you how to hit an 800 credit score. If that's you, then keep watching. Let's get right into it. 800. That number might as well be a myth to some people. If you're sitting at a 580 right now, staring at a declined application or a loan offer with an interest rate that made your stomach drop, 800 feels like something reserved for people who were born into good financial habits and never made a mistake. But here's what I can tell you from my personal experience. It's not a myth, it's a destination. And there's a very specific road that gets you there. I've been on that road. I've watched my own score climb from where most people start to where most people only dream about. And what I found is that the path isn't complicated, it's just not widely explained. So that's what today is, a clear, honest breakdown of every factor that shapes your credit score, how much each one actually matters, and what you can do starting today to start moving yours in the right direction. We're covering 5 factors. They're not equal, some carry 10 times the weight of others, and knowing the difference changes how you prioritize your energy. Let's get into it. Now, factor 1, payment history, 35% of your score. This is non-negotiable. If there's one thing I want you to walk away from this video knowing, it's this. More than a third of your entire credit score is determined by a single question. Did you pay on time? That's it. No formula, no trick. 35% of your score, the largest single slice, is just your track record of paying what you owe when you said you'd owe it. Now, most people here pay on time and nod along like it's obvious. And sure, in theory, it is. But what catches people off guard is how severely a single missed payment can set you back. We're talking a potential drop of 150 points from one late payment. And that mark doesn't disappear quietly. It sits on your credit report for 7 years. 7 years. Let that land for a second. Now, here's something most people don't know about the timeline. If you miss a payment, the world doesn't end immediately. Most credit card companies don't report a late payment to the bureaus until 30 days have passed. So if you forget a due date and catch it within that window, even a few days late, you'll owe the late fee, but the damage to your credit score may never actually happen. Pay it as soon as you realize. Don't wait. The other piece worth understanding is the difference between paying the minimum and paying in full. For the purpose of your credit score, a minimum payment made on time counts as an on-time payment. Your score doesn't know or care whether you paid $25 or the full $2,500, but your bank account cares, because carrying a balance means accruing interest. Paying in full is always the smarter move financially, even if both technically count the same to the bureaus. A simple system that makes this automatic. Set up auto pay for the minimum balance on every card you have, not because you plan to only pay the minimum, but because auto pay is your safety net. You'll still log in and pay the full balance whenever you can, but if life gets busy and a due date slips your mind, autopay means your score never takes a hit. Think about it this way. Every credit card you have gives you 12 chances per year to build your payment history. If you have 3 cards, that's 36 positive marks annually, all stacking up and painting a picture of someone who is reliable, responsible, and worth lending to. That reputation, built consistently over time, is the single most powerful thing you can do for your score. Now we're getting into factor number 2, credit utilization. 30% of your score, the lever you can pull today. Factor 2 is where things get interesting, because unlike payment history, which is built over months and years, your credit utilization can change your score in a matter of weeks. This is the fastest lever most people have available to them. So what is it? Credit utilization is the ratio of how much credit you're currently using compared to how much you have access to. If your combined credit limits across all your cards add up to $10,000 and you have $3,000 charged on those cards right now, your utilization is 30%. The widely cited guideline is to stay below 30%. That's the number you'll hear most often. But if your goal is to get to an 800 credit score, not just a decent score, but a genuinely excellent one, the target is closer to 10%. I know that sounds strict, but here's why it matters. Credit bureaus aren't just looking at your overall credit utilization. They're also looking at each individual card. You could have a perfect, healthy, blended utilization rate, but if one card is sitting at 80% of its limit while the others are empty, that single card can pull your score down. Balance matters across the board, not just in total. So what do you do when you have a big purchase coming? Life happens. Sometimes you need to put a significant charge on a card, a medical bill, a home repair, a flight you couldn't have anticipated. That doesn't have to wreck your utilization score if you're strategic about it. Here's the move. Make a payment before your statement closing date. The closing date is when your credit card company takes a snapshot of your balance and reports it to the bureaus. Whatever's on the card at that moment is what gets counted for utilization. So if you can knock down the balance before that snapshot is taken, you can control what the bureau sees, even if you charge it back right after. It's not gaming the system, it's understanding how the system works and using it correctly. Factor number 3, length of credit history. 15% of your score, the patience game. Here's the one factor on this list where the honest advice is there's no shortcut. The length of your credit history accounts for about 15% of your score, and the only thing that builds it is time. When lenders look at your history, they're examining 3 things: how old your oldest account is, how recently you opened your newest account, and what the average age of all your accounts look like together. The older and more established that picture looks, the more it works in your favor. So 2 rules that protect your history. Rule 1, get your first credit card as early as you possibly can. Even if you don't plan to use it much, even if you just put one small recurring charge on it and pay it off each month, you want that clock ticking. A credit history that started at 18 looks very different at 30 than one that started at 25. Rule number 2, and this one trips people up, do not close old accounts. I've talked to so many people who paid off a card and then immediately closed it because they felt like they were cleaning up their finances. What they were actually doing was erasing history and shrinking their available credit at the same time, both of which hurt their score. If a card has an annual fee you don't want to keep paying, call the company and ask to downgrade it to a no-fee version. Most issuers have one. You keep the account open, the history stays intact, and you stop paying for something you're not actively using. Beyond those 2 moves, the honest answer is let time do its job. Keep your accounts open, keep them clean, and the history will build itself. Factor number 4, new credit inquiries. 10% of your score where timing is everything. Every time you apply for a new line of credit, card, a loan, a lease, the lender pulls your credit report. This is called a hard inquiry, and it temporarily affects your score. Now, the internet has made this sound scarier than what it actually is. A single hard inquiry is a minor, short-lived ding. We're usually talking a handful of points, and the effect fades within a year or 2. The bureaus understand that people apply for credit periodically. It's not inherently suspicious. What the scoring model is watching for is a pattern. Multiple hard inquiries in a short window can signal that someone is in financial trouble and scrambling for credit. That pattern raises flags. One application every several months, completely normal. The one situation where you should pause, if you're planning to apply for a significant loan in the near future, a mortgage, a car loan, try to hold off on any new credit card applications in the months leading up to it. Lenders for major loans look closely at recent inquiries, and even a few minor dings at the wrong moment can affect the rate you're offered. The difference between a slightly better and slightly worse interest rate on a 30-year mortgage can add up to tens of thousands of dollars. It's worth the patience. Outside of that scenario, don't be afraid of applying for new credit when it makes sense. In the long run, more accounts with positive history is a good thing. The short-term dip from a hard inquiry is almost always worth the long-term benefit of a new account well managed. And last but not least, factor 5, credit mix. This makes up 10% of your score. Don't force it, but don't ignore it. The 5th and final factor is credit mix. The variety of credit types you're managing. And this is probably the one where I'd urge the most caution about taking action, because it's easy to make a bad financial decision trying to optimize a factor that only accounts for 10% of your score. Here's what it means in plain terms. Lenders like to see that you can handle different kinds of debt responsibly. A credit card is revolving credit. The balance changes month to month. A car loan or student loan is an installment credit, fixed payments over a set period. A mortgage is its own category. Having a mix of these tells lenders you're not a one-trick borrower. The right way to think about this, the key word here is naturally. You should never take on debt you don't need just to diversify your credit mix. Taking out a personal loan you can't justify financially to bump a factor that represents 10% of your score is not a good trade. Instead, let your credit mix develop as your life does. If you buy a car, that's an installment loan. If you eventually buy a home, that's a mortgage. These things will come in their own time, and when they do, they'll strengthen your profile. In the meantime, focus your energy on the factors that have a far greater impact. The credit mix rewards people who have lived a financially active life over time, not people who rushed out to manufacture one. So let's take a look at the full picture. 35% of your score is payment history, 30% is utilization, 15% is how long your accounts have been open, 10% is new credit activity, and 10% is your mix of credit types. That means if you lock in factors 1 and 2, on-time payments and low utilization, you've already addressed nearly 2/3 of your entire score. That's where the work pays off fastest and most dramatically. The other 3 factors matter, but they build gradually on their own as long as you're not actively working against them. The roadmap looks like this. Start with autopay, eliminate the risk of a missed payment completely, then look hard at your utilization and get it below 30%, or better yet, below 10% if you're serious about chasing 800. Don't close your old accounts. Be thoughtful about when you apply for new credit and let the rest develop naturally. None of this is fast. I won't pretend it is. Moving from 500 to 800 is a journey that typically takes years, not months. But the most people who get there aren't doing anything magical. They're just being consistent with the fundamentals over and over until the score catches up to the behavior. And one day you refresh your app and the number is there. Your credit score is not your identity, but it is a reflection of your habits, and habits, more than almost anything, can be changed. Wherever you're starting from, 500, 600, 650, the same 5 factors apply. The same moves work, the same patience is required, and the destination is available to anyone willing to put in the time. If you found this video helpful, drop a comment letting me know where you're starting from and what your goal is. I read every single one, and there's something genuinely motivating about seeing people decide they're going to take this serious. As always, if you need credit repair, we offer a $60 a month credit wipe program. No contract, no commitment. You can cancel at any time. Until next time, I'm Gilberto from Credit Guys. Take care.